Hey everybody, Signet here with the Bullish Bears, and in this video I want to do a review of all of the introduction to options that we've gone through so far. At this point, hopefully you're beginning to grasp a little bit about options on the back side of everything. All right, we haven't discussed really in any way how to trade these. We've just kind of introduced the different parts, the different pieces, the things that make up the value of those options, why those options values change, how we could quantify or measure that change, and anticipate what the new options value would be based on all of those metrics. But it's worth taking a pause and kind of talking things out a little bit. Stock price does not move from strike to strike, right? At any moment throughout the trading day, stock price moves a few pennies higher, a few pennies lower. It goes and jumps 2 or 3 pennies higher and lower, right? It's all over the place all day long. Stock prices are moving up and down. So we can't draw some linear line that says, oh, the delta is 53, and when SPY goes from 410 to 49, that value is going to be applied, or that value is going to be taken away, and it would be some exacting perfect thing. It just doesn't work like that. There's a system of measurement within the options world called binomial. All right. And in this binomial system, every second the market is asking, where can we go here? We can go up a penny, we can go down a penny. All right. So every second of every minute that the market is open, we can go up a penny or we can go down a penny. And then when we do that, in the next second, we can go up a penny back to our previous value, or we can go down a penny to a new value. And then from there, we can go down a penny or we can go up a penny. And you see that that's what the market is doing nonstop all day. It's making this binomial decision. Why am I bringing this up? Well, when we're looking at the options chain, we're all trying to figure out what's the best strike for what I'm trying to accomplish. Which would be the best collection of strikes if I'm trying to do a spread? What kind of risk am I dealing with? What kind of reward am I dealing with? How much will this option change if the underlying market moves up or down? That's the answer we're all trying to get. And unfortunately, there is no exact answer to this, and that's because there's just too many variables. An options price can move up or down based solely on people trading that option, even if the underlying market doesn't move at all. The best way to explain that is to forget about options altogether for a minute. All right, let's just ignore options completely and go out to a chart. Now the chart can be stock or it can be futures, but not an options chart. Okay, so we're looking at SPY, and while we're looking at SPY, we want to look at the bid and the ask. That's in the upper portion of the screen here. So on SPY, we had a bid of 410.51 and we had an ask of 410.70. Now, of course, that was after hours. The market was closed, and the bid ask got a little wide. But that's the bid ask. And the way the market changes its price, the way SPY's stock would change, is if a buyer comes in and reaches for one of these orders, right? So the buyer is going to hit that bid price or the ask price, right? Of course, we want to buy it as cheap as we can, so we're going to try to get in on the bid. Nobody's going to want to sell you there, right? All the sellers are trying to get rid of it at 410.70 and all of us buyers are trying to pick it up for 410.51. Obviously, if nobody is willing to sell it to us at 451, then we got to go to 410.52, 410.53, 410.54. And we have to keep asking that question, is there anybody willing to sell me one of these at this place? No. Okay, I got to go higher. I got to keep going higher until I can finally find a seller at 410.70. But what if I'm not the only one trying to buy? And suppose there's only 20 contracts, 20 shares of stock sitting at 410.70. And before I can execute my order, those 10 are gone. Poof, somebody bought them. And now there are no more shares at 410.70. Now I'm going to have to reach even higher than that. And if I'm working the order and I'm trying to get it filled and I'm not being aggressive and I just set my order at my own price or at the mid at that point, and there's nobody willing to sell them to me, I'm not going to get filled. But anybody who reaches past the current or the last price traded and they reach higher than the ask, they'll get filled. And that will move the stock price again, right? So the way that stock price changes or futures price changes is when people are trading at the ask and above the ask, and they'll drive the underlying market higher. Or they're hitting at the bid and below the bid, and they'll drive the underlying market lower, right? So that's the way stock price moves up and down with no option at all, right? So now let's take that same concept, that same discussion, and let's go back to the options tab. Through all of these videos, we've discussed how the underlying option value, usually the mid price, will go up or down based on some impact from the Greeks. That time would go by, or that gamma would affect the delta, and delta would be applied to the option, or that implied volatility would be applied to the options price, and that the options price would go up and down based on these Greeks. But that's not the only reason. The other reason that the options value would go up and down is because if there are aggressive buyers hitting at the ask or above. So if we highlight at the ask, and we're looking at something like the 411 strike, the asking price is $8.73. And if I'm trying to get filled and I'm trying to buy this at $8.73, but I'm standing in line and there's 40 people in front of me and all of those people are also trying to buy a lot of this same strike, I might not get filled. I might not get filled because I have to stand in line and hope that there's still some left when I get there at that price. But if I really want filled right now, no questions asked, give me my call, I want it. All I have to do is reach above that asking price. So if the seller says, I will sell it to you for $8.73, and there's 20 people standing in front of me, I can reach over that seller and find the next seller even higher than that, and I can buy it from that person instead. Maybe that person is selling his contract for $8.75. I paid up, I paid more money than everybody else was paying, and I got my calls. But I also moved that call strike price higher. So anybody who was trying to sell it at $8.73, now they're not going to get it because I jumped right past them, right? I moved that value up. The $8.73 person would very hopefully see, why would he sell them at $8.73 if he can now sell them for $8.75? And he'll pull them off. He won't sell them there anymore. Now nobody can buy his because he pulled his off, and now they have to pay the new price. So traders can move these values. If we're hitting at the bid and below, then we can drive that bid price down. If we're hitting at the ask and above, then we can drive that asking price up. We can. And it has no connection to what's SPY doing. Is SPY going up? Is SPY going down? It wouldn't be affected by that. It would be directly affected by the traders coming in trying to trade that. Now, liquidity at this point would be very, very important. SPY has a lot of liquidity. Thousands of contracts are traded all day long in here. Thousands per strike are traded. And so if price gets just a little out of line, arbitrage and other traders, we put it right back into its place. But you start getting into trades where there's not very much trade activity, and now the numbers start to be greatly affected by the last trader. So take for an example Google. The bid ask in here is really wide. We're looking at like almost a $7 difference between the bid and the ask. If I'm very aggressive and I'm not trying to hit the midpoint, but instead I come straight in here and I buy that at 77, and I take all of the offers that are at 77, the next person is going to have to try to reach higher than that. If that is the going last price, then the bid and the ask on each side is going to get even wider, right? Look at the current last price. So I don't have it showing. We want to go in and bring up last. And that way we can ask that kind of question. What was the last traded price of that option? $76.70. Where's the bid? At 77. Where's the ask? 77. So we had 70.70 on the bid and 77 flat on the ask. But the last price traded was 76.70, much closer to the asking price than the bid price. Now that gives us a little information. It shows that very likely the last calls that were traded were buy to open, and the last price paid was 76.70. If the last price paid, or the last transaction, would have been closer to the bid, that would have showed us that very likely the last trade performed on the call side was sell to open, not buy to open. But either way, if we come in and continue to hammer down on one strike in one series, in that one expiration, we can drive the value of those particular options higher or lower, whether or not Google moves at all. Now, everything is connected. So while a market maker would be in there willing to offer me the call that I'm going to be buying, if I buy enough calls from that broker, that market maker or that broker is going to need to protect himself, right? The way that they perform things is they keep track of their delta value, and they want to make sure that they remain as neutral as possible, so that if the binomial system says that we can go up or down from here, $1, 1 penny, whatever, at any point in time, we can go higher from here or we can go lower from here. They want to remain as delta neutral as they can, so that if the market makes an outsized move, they're covered. Well, how do they get rid of that very extreme delta value? Because if they're coming in here selling me calls, I'm buying up all those calls. I'm just buying and buying and buying. I'm getting a very, very high delta value, and they are getting a very, very negative delta value. Well, they need to get back to delta neutral. The only way that they can get delta neutral is to go out and get more delta. Options have a soft delta, and stock has a hard delta. So if all of us traders are pounding away and we're just buying a bunch of calls, the market makers start to get an extremely negative delta. Say we drive them into a 10,000 negative delta, they've got to get rid of that negative delta, and they will go out and buy the stock. They'll buy the underlying market. And when they do that, they will drive Google's price higher because they are trading Google. They are buying more of Google to get back to delta neutral. That's why if we come in and buy a bunch of calls, we can literally force the stock price to move because the market makers have to go buy stock to cover all the calls that they've sold. This situation, as I've just described it, is what is referred to as a gamma squeeze. It's not gamma. I didn't mention gamma, but that's what it's called. So if you hear somebody saying that there's a gamma squeeze going on, this is what they're referring to. They're referring to the idea that we're forcing market makers to buy the underlying stock because they're trying to get back to delta neutral. The reason I bring all of this up is I am constantly asked about options value. How can we tell how much the options value is going to change? We can't. We have really close estimations. There's a lot of really great machines out there that can give us some ballpark idea, but at the end of the day, we just can't tell that answer. And that makes it very difficult when you're trying to calculate or define your risk to reward within a trading system. If you were to buy this call, for an example, and spend $7,700 to buy that call, how would you know how far Google has to move for you to see profit? And what kind of profit would you be aiming for? How far would Google fall before your stop was triggered? And what should your stop be? This is where the trouble comes in with trading options. It's important to understand that one of the reasons we can't answer this question is because options were never designed to be day traded. Options were designed way back in the day to be a representation of a promise to sell stock. All right? These are contract agreements to buy and sell stock. And they were designed to be done for expiration trades. And so most of the trade systems out there still focus on that end goal. There's things like black box stocks and cheddar flow and tradie tick that will do all these various computational programs and give you some estimation of the change in the underlying option. Those kind of programs exist, but they're still going to be an estimation because at the end of the day, they don't know if that option is going to get a lot of traders coming in and hitting at the ask and above, or hitting at the bid and below. And when that kind of trading happens, it will drive the price of this option in that direction, even if the underlying stock never moves at all. So, when you think about how much will this option change, and you're trying to determine that answer, you don't have to look at it and think to yourself, I must not know how to do this because I can't seem to find the answer. It's not because you're new. It's not because you don't know something yet that somebody could teach you, which would suddenly enlighten you to the answer. It's the fact that nobody can answer that question. Again, you can get a pretty good idea of how much these things are going to change, but at the end of the day, it's just a ballpark, right? It's a guesstimation. It's a rough estimate. It's a probability. This is where you have to get a feel for trading options. And you have to get a feel for trading options in a particular stock. The way that Google's options change in value, for an example, is completely different than how SPY's options change in value, because SPY is one of the most liquid products out there, and it is heavily traded by the machines. There is no slippage, there is no arbitrage, there is no opportunity for you to find some edge within the options pricing model, not in SPY. But a more illiquid product with a wider bid-ask spread and a very expensive stock price, there's a lot more slippage in there, and there's a lot more opportunity for arbitrage and for individualized mispriced options for very small amounts of time. Anything mispriced will get hammered back into place relatively quick. The main takeaway that I want to provide in this video is that it's not on you. It's not your fault that you cannot figure out where the value of that option will be in the next 10 minutes or the next hour. It's not your fault that you can't quite determine how far the underlying has to move before it triggers your stop, because there is no real good way to do that. Right? There's only getting a feel for it and doing it. So one of the things that we can do to kind of help with this is a very fancy term called strike price shift differential. And I know that sounds really fancy, but at the end of the day, we're basically saying look up the chain and look down the chain. Look at how much the option value changes when the underlying stock changes. So for an example, here is the mark. And with the mark, if I was looking at the 410 call, that would be a call traded for $9.25. I'm just going to round up a little bit. So if I bought it at $9.25 and then SPY makes a $1 move, how much could I make versus how much could I lose? Well, we can do that math. Now, the way I do it, I normally just, in the middle of the day when prices are moving, I round everything so that I can do the math really fast. That would be 925, and the next strike farther away would be 975. I know it says 981, but in the middle of the day when I'm trying to get a trade and I need quick numbers, this is my way of getting those quick numbers. I use quarters. Now, depending on what you're trading, you may want to use nickels or dimes or quarters, whatever suits you, right? But we're looking at 925 versus 975, the way I do things. And that means if SPY moves in the right direction, what I bought with the 410 for $9.25, I would be able to sell later on for a 50-cent profit, because we went from 925 to 975. If you subtract those two, you get 50 cents. So if I'm right and SPY moves $1 in my direction, I'll make around 50 cents in that move. That's not too bad. But what if I'm wrong? Well, the next strike down is 875. So if I bought it at 925 and then I sell it for 875, then if I'm wrong, I'm going to lose 25 cents. Excuse me, 50 cents. So it's still the same thing. My risk to reward in this trade is risk to reward is 1. Right? For every penny that I'm risking, I'm having a chance to make the same. Right? So now I could take a trade in SPY and look for a $1 move in my direction and close for a 50-cent profit, or I could look for a $1 move against me and decide to use that as my exit for a loss. I wouldn't need to sit here and focus on where my stop should be, or asking the question, am I still right? Is this still a good trade? How much am I risking? I can literally look at the underlying and say, okay, if the market moves up $1, I'll close it. If the market moves down $1, I'll close it. And what would my risk to reward be? So very fast, very quick numbers. Those were not exact numbers, but they were kind of close. When you use the rounding feature in the middle of the day, because, when you're day trading, everything's happening very fast. The market's moving. These numbers are flashing. Things are moving up and down. You're trying to get filled. And you need to be able to quantify what your risk is, right? How much you really putting on the line, and are you comfortable with that risk? What if things get out of control when you get in, right? So we need those numbers. If you did want to be a little more exact and say use nickels to round with or dimes, then in this situation we would be focused on something like 925, and then our plus minus would be 980, and 870. So from 980 to 870, we're looking at what? $1.10? And in the middle of both of those is 925. And we can do the math again. Here's that same binomial process that I talked about in a previous video. From our current location, we can move up $1, we can move down $1. When we get there, what will be the new price? We'll be at 980 or we'll be at 870. Once we get to that location, we can ask the same question again. Okay, the underlying market moved. We're now at 870. Now what? Well, from 870, we can move up $1 or we can move down $1. And in that time frame, it'll be 815 versus 925, right? We can do that same binomial process. So hopefully this video has instilled upon you the idea that you're not missing some piece of the puzzle. That puzzle piece just doesn't exist. And that the best you can do is try to come up with some vague outline for how much you're willing to risk and how far you think the underlying market would need to move for you to see profit. It's also worth noticing how the options change in their different locations. Now, through all of these different videos so far, we've talked about the Greeks and the underlying markets, and we've shown that bell curve and how most of the Greeks are centered around the at-the-money area. So when you're trading at-the-money options, they're going to have the greatest change in value. But that does not mean that things out of the money won't change, right? They're just going to change at a slower rate. So for an example, the 416, it's a $6.20 option. If the market moves in my favor, what I bought for $6.20, I'll be able to unload for $6.65. That's a 45-cent profit. If I'm wrong, it's going to go against me, and I would be able to unload it for $5.75. Right? So you can see how I can, again, recognize my risk to reward in something a little more cement. But these numbers are not exact. This quantifiable perspective on strike price shift differential is not showing us how much Vega would impact this. If the market moves very fast, implied volatility will go up. If we are all sitting in here hammering away on the same strike, like when you have an unusual options activity alert, and one particular strike is being heavily traded, and especially in an illiquid market, then that one strike options value can change drastically, even if the underlying market doesn't move. So these strike price shift differential examples is missing out on that logic, and they're not perfect representations of your risk, but they're a really good place to start. And the rest of it would come from getting a feel for being an options trader, right? The more you trade the same market over and over, and you deal with the same kind of options in the same strike area, in the same days to expiration area, you will get much more familiar with how a particular market's options change on a day-to-day basis. A common SPY trade before COVID was generating somewhere between 25 to 30 cents in the underlying move. So if SPY moved $1, we would make around 25 to 30 cents on the dollar. It wasn't great, but that was just about what you could expect. Now in the current market, the value of the options are drastically different, and how much they change in a $1 move is drastically different. And it's going to continue to be this way for at least another year or two. SPY has not had an implied volatility level anywhere close to its pre-COVID levels since COVID hit. So, here we are a few years later, and we're still trading at a very high elevation of options values. So get used to it, but it will eventually begin to subside. Doing this kind of math is also how you can help yourself figure out what you want to trade all the time. I know people, for an example, trade Tesla a lot. There's entire communities and trading firms that focus on nothing more than trading Tesla all day, every day. There's other places that focus on trading AMD all day, every day. And then there's others who just trade SPY all the time. There's absolutely nothing wrong with that. In fact, it will help you become a better trader if you focus on one underlying all the time. Now, this is a day trade discussion, right? This entire video is about how the underlying option would change in the day through the moves. And hopefully, I've impressed upon you that the value of the change in the option has so many different features and characteristics and influences that you will never exactly be able to pinpoint how far the underlying market has to move for you to make or lose X amount of dollars. But you can get a feel for it, and that's what I encourage you to focus on. Right? It doesn't come from a book. It doesn't come from videos. It comes from you going in and trading the same things over and over again, preferably in your learning process on paper. Right? I say that, but I didn't trade paper. I just traded live and learned as I went. I'm not encouraging you to do that. I'm just telling you what I did do. Okay? So that's what I got for you guys. I hope this video helps provide some perspective, and I look forward to seeing you at the next video.